buy things when they're expensive and sell them later at a lower price. You want to do the opposite of that. You want to buy low, later sell high. There's actually a systematic way that you can do this. Let's imagine that we were dropped into history somewhere between the year 1920 and 1979. Wherever we land, however, our task is that we have to invest in the US stock market for the next 40 years. Now, I'm gonna give you a choice between two investment strategies that you can pick from. The first one, option one, is very simple. You can invest $100 a month for that 40 years, no matter where you land. Option two is you can save up that $100 a month, keeping cash on the sidelines. And you can wait for when the market dips, and you can try to buy those dips in the stock market. Now, with this option, I'm gonna sweeten the deal. I'm gonna grant you perfect knowledge of the future, and you'll always be able to buy them at those absolute bottom prices. Question is, which of these would you choose? Option two sure is enticing, isn't it? I mean, it just seems like a slam dunk. Well, someone ran this experiment, and I want to share with you the results, and I'll tell you how to read it. When this blue line is above the horizontal dotted line, what that means is that it was a period in history where that buy the dips strategy, that was option two, was the better choice to make. 70% of the time, a monthly investment outperforms in history. Very interesting, 70%, pretty impressive. But I granted an enormous advantage to the second option, perfect knowledge of the future, right? None of us have this. And so in practice, that option two is very hard to get right. So let's account for that. Let's say we get it wrong by just 2 months in terms of that timing decision, and then recrunch the numbers on this problem. And what we find is that when we do that, then this monthly investment outperforms 97% of the time, virtually the entire experience. Now, how can this be? What is this magic of investing monthly? Well, it's not magic, but it is a very simple concept, and it's called dollar cost averaging. Perfect example is our $100 a month. Now, the dollar amount can vary, the frequency can vary, but it's a fixed amount of money at regular intervals over time.